here, because I know you and the team have put out a note in the last few days about the tectonic shifts that we've witnessed in the global economy and in markets as well. Alex, this regime, how different is this regime going to be to years, decades gone by?
Very, I think, is the short answer. You know, you were debating earlier the end of the Great Moderation. We're pretty clear. We have seen the end of the Great Moderation. And that reflects a different geopolitical environment, a different macro environment. And markets are beginning to catch up with some of that. But they're not really catching up with the fact that, for example, the geopolitical environment has changed absolutely fundamentally. And even if we can't spot the triggers ahead for geopolitical events, including around the Middle East now, we know that over the next 10 years, the average supply shock facing the global economy as a result of that is going to be negative, in the same way that for the last 20 years it was positive. So central banks are going to find themselves fighting inflation much more often, even as we get out of this episode.
Alex, you did a tour of duty at the Bank of England on financial stability. It's not appropriate for you to discuss the executive dynamics and the performance dynamics of BlackRock, but you can advise on a bond route that every portfolio of BlackRock, every portfolio Rick Reeder and company has. They're all south. How do you advise your team this weekend on the instability or stability of the bond system?
Well, we've actually been underweight for many years the long end of the US curve. We saw two things needing to happen. One was a repricing of the average level of policy rates as we go into this regime where central banks are going to be fighting inflation more often. And the other was a repricing of the term premium, which is now taking center stage in the market debate. Those things are now beginning to happen. And we've reached a level, we think, where we've become a bit more neutral in the short term. We see risks now in both directions. But still, over strategic horizons, we remain underweight the long end because there's still not that much term premium. And this is an environment where you've got weaker trend growth, higher level of policy rates, the fiscal dynamics are very difficult as a result, and that's an environment that demands a term premium.
Alex, earlier to this year, we were talking to a number of bond strategists who said 2.5% on the real yield was basically the tipping point where stocks would sell off and it would be this reinforcing cycle. Are you saying that that's not true, that we could get to a 3%, we could get to a 3.5% and be a more accurate term structure for the economy as you see it?
Well, over the longer term, certainly, we could go higher from here as the term premium gets re-established. But I think it's important to note that as the term premium gets re-established, that's not necessarily bad news for equities. What's strange up to this point is that policy rates have been, or future expectations of policy rates have been repriced. And yet we haven't seen the equity market really respond very decisively to that in aggregate.
So does that mean to you, Alex, that returns going forward aren't necessarily going to be reduced, but that stocks are just going to have higher multiples, that they're going to be a better engine of growth and reliable counterweight to inflation and a higher term premium type of structure for bonds?
Well, I think you see two features favouring equities in the long term. You've listed both of them there. But I also would note that even if it's a challenging environment, the end of the Great Moderation, it's a challenging environment for broad risk asset exposures. Actually, the drivers of the end of the Great Moderation, whether that's geopolitics or the energy transition or demographic change, they're all big mega forces changing the way our economy works. And we're much more interested in those now as sources of return in portfolios.
Alex, I'm absolutely fascinated on a broader view, and again with your tour of duty at the Bank of England, if with the Great Moderation over, as you stated, are we going to have an actuarial reset of our generation, or frankly, multiple generations? Do we need to start thinking about a bond reset to a higher required return for pension investments?
I don't know whether it's a higher required return, but we're definitely having a reset to a higher actual return environment. And this, by the way, is why it's strange that equity multiples in aggregate haven't yet adjusted to what's happened in the bond market. We see yields remaining at close to these levels over the long term, as maybe higher as the term premium gets re-established, because we're going into an environment now where the Fed, other developed market central banks are going to be leaning against looser fiscal policy than they were in the past, and they're going to be fighting, on average, these negative supply shocks, whether that's energy prices, other geopolitical shocks, or demographic-related labor supply shocks. So returns are going to be higher once we get through this adjustment. We're seeing that now in the bond market. We're going to need to see higher returns in the equity market and a range of other markets as well in the future.
Alex, just quickly, when you and the team use that phrase long term, how many years is that? What are you thinking about?
Well, in a strategic portfolio, we're looking 5 years and out. In a tactical portfolio, we're looking over the next 12 months, and we see over the next 12 months the risks in the long end more balanced. But beyond that 12 months, we still see the term premium grinding higher.
So when you say high for longer, you're actually thinking about high for maybe over the next 5 years?
Absolutely. And I think that what's interesting in the way the Fed debate has gone is, as people have focused on reaching the peak, the market has then begun to shift its attention to, well, what does the future look like? Where do we go back to as inflation comes down? And actually, we think that's a lot higher than we were pre-pandemic, partly because of the fiscal position, partly because of the energy transition, which is driving higher investment, and partly because, as I say, central banks are going to be, on average, facing supply shocks where they're constantly needing to push down on inflation, which means holding rates, on average, tight.
Fascinating. Alex, thank you. Alex Brazier there of BlackRock. The latest from them, the Investment Institute, and what's going on in this bond market. If you are just joining us, welcome to the programme. The S&P 500 at the moment, negative by 0.2%. When we talk about high for longer, let's talk about what the longer means. For Alex and the team, as they look at bond yields at the moment, Bramo, they're talking about maybe over the next 5 years. Get used to this.
And then what? And we don't know what the and then what is, which is just yet another layer of uncertainty. The funny thing is that doesn't necessarily mean in his eyes that stocks are going to underperform. And this is the sea change that I've seen, is that there isn't a natural correlation to bonds selling off and that actually creating a headwind, given how high yields go for stocks, because really it is being driven by the way Lee kind of artificial intelligence and all of these other kinds of trends.
That was a conversation of the week with Mr. Brazier there. That was really, really sobering, and that's a complete readjustment that you're going to begin to see. And on a microcosm basis, it will be a percolation like Credit Suisse marking down global real estate 9%. Multiply that in a dimensional basis, John, 20, 30, 40 different ways. I mean, his idea of longer, John, longer is when Tottenham wins the Premier League. That's how we.
That's like.
That's
I think we're speaking
how we put it out there.
In decades, right?
Well, he's a British guy,
Not
but
in years,
what
right?
you heard there, folks, bottle it. That was a really important discussion.
He was absolutely fantastic.